Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined by George Goncalves, MUFG's head of U.S. macro strategy. It's Tuesday, October 19th, 2021. Welcome back to the podcast, George.
Great to be back, John.
Always great to have you. Let's kick this off. So, George, in conversations, with me and you probably put it in your pieces as well, but you've dubbed the latest move, in the market and on the curve as really the tale of two curves. I was curious if you take our listeners through, what's really going on across the different parts of the yield curve.
Absolutely. So we're I think, at a stage where a number of things are going on, and it's also important the time of year as well. It's mid-October. We're heading towards November, just naturally, and the trading days are getting less and less each time we kind of look up. And I think that there's a scramble to both realign positions and kind of rethink what may lie ahead into the new year. I think we're trying to get some early thinking about that. I mean, a lot of it linked to what we now are clearly finding out is no longer a transitory inflation. Transitory is out and persistent inflation is in. Judging by the most recent readings that we got from PPI and CPI, and just by our own analysis of where inflation may be heading, at least for the next 3 to 6 months, it's going to be very difficult to see a significant pullback. I think the market's really starting to factor that into both the curve, but notably on Fed hiking expectations, and that's really led to a move higher in short-term rates more so than long-term rates. But linked to that, and this is also, by the way, not just a U.S. phenomenon, largely a function that most global economies are going through similar fits and starts as they get their economies back into recovery mode. Global rates have had a pretty big sell-off in the last week and a half as well. And in fact, some of these overnight moves, like in the UK interest rate market, the gilt market, as well as moves down in New Zealand, really were much more larger than what we saw in US rates. But nonetheless, I've also kind of dubbed it the birds of a feather flock together front end sell-off. And this is, again, a function of central banks starting to realize that this inflation is a little bit more persistent than they had initially thought, and they're going to probably have to pull forward their own hiking campaigns. And then I guess third, which is again also related to this, is the pretty high and still looking to move even higher commodities complex, driven by energy sector and oil and things like that. If you look at oil prices relative to like 10-year inflation expectations as calculated from the TIPS market, they're basically going 1 for 1 right now. So, or even 5-year TIPS, which has an even stronger relationship. So you have, the inflation is the overarching kind of feature to this overall sell-off, and it's showing up mostly in the front end, as the view is that central banks are going to be credible and they realize that they've produced or provided too much liquidity, and that they're going to have to scale back. And that eventually, if the central banks do get in gear and start to tighten, that inflation will come back, into check. And that's why longer term rates are at least acting a little bit more stable.
Got it. So we've got, to summarize, we've got what's clearly become, not transitory, but more persistent inflation. Got a little bit of price action being drove from overseas, plus the whole commodity thing, and all those things are causing the Fed to act, which is, hitting the front end and belly of the curve, but also potentially arresting future inflation. So the long end supported. Is that about right?
That's about right. I mean, if you would actually look at all three all three tenors on the yield curve, like let's say the 5-year, the 10-year, and the 30-year, and if you look at the rolling 1 month change, the 30s are up slightly, but it would look like as if there was no sell-off altogether in the last month. But if you look at 5s and 30s, they're at getting close to a 1 month high in terms of like their rolling changes. So it does kind of argue for maybe that the sell-off has been a little bit too quick, and at some point we'll stabilize here. But it's definitely down the curve is where all the price action is.
Got it. That's helpful. So, George, MUFG recently published the Global Markets Monthly for the month of October. lot of good stuff in there, but let's focus on your stuff, specifically the U.S. fixed income section. There were two interesting parts of it. The first was, taper wasn't priced in after all, and the second was, as you put it, STIR rates are stirring up some trouble for the Fed. And as many of our listeners know, STIR stands for short-term interest rates. Could you take us through both sections of the piece, kind of summarize the high points for our listeners?
Yeah, maybe I'll start with the STIRS part because it's kind of related to the first question and just our first talking point around what's driving curves. It's definitely the front end. And the one thing I feel pretty strongly about is that, again, with this sticky high inflation and central banks likely behind the curve, it's, at least relative to the last cycle. Remember, the last cycle, we were on hold for up teen years. I mean, I don't know. The Fed didn't hike until 2015, which I think was about 7 years post crisis, and of nearly 9 years after the last time they hiked in 2006. So it was like a super glacial long time waiting for hikes. I think we're not going to have that this time around. We're going to have a much quicker cycle, and that's going to introduce a lot of macro trading opportunities. And I think that that's coming back with a vengeance. So that's kind of the gist of the STIRS story. That when we look back at some of the relationships of short-term forward rates, they don't look like they did back in 2013, 2015, when we had a taper tantrum, when we had a pretty big repricing back then. It's only now starting to move higher, especially like at the one-year rate. So I kind of went through like the idea that if this is a faster hiking cycle, it might be a shorter one as well. And that's kind of what 30s are telling us as well. So if we kind of get this, let's say the Fed hikes quicker in like 18-month window, maybe they won't have to go further beyond that. And I think that's kind of where I was looking to get at with those two charts, as well as those that received it, that section of the piece. And then on the tapering wasn't priced in. In order for the Fed to actually even hike, they're going to have to start tapering first. We haven't even had the taper done, although we've been talking about it all year long. My view has been all along that tapering is like tightening in an exact sense, but it's all about the rate of change. And if we're producing or providing less liquidity, we meaning the Fed, and into the overall U.S. dollar markets, then as we get tapering, the market will know that very shortly thereafter there's going to be hikes, especially if inflation is still running high. So if inflation is still running high throughout the period when the Fed is tapering, then it does open up the possibility of even a June hike next year. So like all this is much quicker than what we saw in the last hiking cycle. And so that's the kind of message that tapering wasn't priced in, maybe not what investors were initially looking for. I mean, there was a lot of focus initially on forward steepeners and just steepeners in general, and that tapering was going to take is reintroducing term premium, and that who's going to buy all this debt. The facts change as information comes in, and right now, if there's going to be less issuance of long-term treasuries, as maybe we won't get the really supersized fiscal packages. Maybe we're going to see a reduction in overall treasury supply relative to the peak that we saw during the pandemic. There's going to be less supply too, even though the Fed's not buying. So we're going back to more of a traditional rates market, which will be linked to Fed expectations.
Okay, got it. I think looking at current pricing, looks like the market's pricing the first hike, I think by the end of September. So interesting to note that you think, like, assuming everything goes right, they could be hiking by then, or even by June. So let's move on here. So the Treasury market ended up closing very close to your Q3 target of 150 on 10-year Treasury yield. So number one, congratulations on that. I think you're calling for 1 5/8 for the end of this year. So please confirm for me that that's correct. And I think I think our listeners would appreciate kind of the more general outlook. What are you expecting from the fourth quarter?
Thus far, our overall view, although it was a wild ride from the spring through the summer, where we initially had the view that rates would head lower first before heading higher, and holding on to that view when the 10-year was close to 1% and looking like it was going to make new lows was definitely gut wrenching. So I will admit that, but glad we stuck with our view that we would get into the second half of the year, especially into the end of the year, with both higher rates. And some of that is linked back to just again, the Fed pulling back liquidity, and I think at some point we will get a debt ceiling resolution, but that's still out there. So I don't want to jump to any conclusions yet, or suggest that there's no issue with that, because I am still worried about the debt ceiling into December. So that then, kind of piecing together the things that we at least know at the present moment, going up to 1 5/8, maybe even going a little bit beyond that, and maybe trying to retest the earlier year-to-date high of close to 175 in the 10-year is totally doable. But at this point, really, a lot of this, I guess, hinges on what happens with commodities and what happens with how aggressive or hawkish the Fed is or not. I think that the risk is for dovish taper, just because the Fed's probably willing to let the markets run a little bit, because by the markets raising or lifting up rates, it's kind of tightening the Fed's financial conditions a little bit in the short term, but they don't want them to run too far ahead. So I think that you might get a dovish taper at the upcoming November meeting, and that could maybe re-steepen out the curve and take out some of these hikes that are priced in. Meanwhile, if oil keeps trucking higher, the question that investors have to ask themselves, like, where does oil go first? Does it go to 65 or 60 again, or does it go back? Or does it go to 100 and make a new local high? If we do, then it's going to be hard for the 10-year not to go higher as well, given this kind of linkage of break-evens widening with oil. So there's a lot of moving parts going on right now. I think it's definitely an exciting time. Again, the trading year is coming to a close. I know it's early to say that, but each day we march towards that end date. I think that investors are going to be looking for both opportunities and hedges as we get closer to the end of the year.
Yeah, no, that's well said. Not a lot of real estate, between now and then, but certainly a lot of trading to do for sure. So, as a reminder for our listeners, if you are not receiving George's strategy reports, reach out to George, to me, to your MUFG sales rep. And George, thanks for coming on the podcast. Great stuff as always.
My pleasure. Thanks, John.
Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.